Should you grant an owner-financed mortgage in a real estate transaction? We'll demystify this topic in the following video. My name is Chris at HouseIt. HouseIt is the largest for sale by owner and buyer agent commission rebate company based in New York City, established 2014. The short answer is no. You should not, and definitely not, grant an owner-financed mortgage or any type of seller financing to a buyer because, well, the buyer probably can't get a mortgage from a bank and a traditional lender in the first place for good reason. The most likely reason is because the buyer simply isn't financially qualified. Therefore, why do you think you can do a better job vetting the financials of a potential buyer versus a bank who has already rejected him for a traditional mortgage? The most likely reason that the buyer can't get a regular mortgage is because he or she simply doesn't make enough income to cover the anticipated housing expenses with an acceptable margin of safety. As a result, through interviews with various lenders, mortgage bankers, and brokers throughout the city, we've heard that owner finance transactions typically default greater than 50% of the time and as high as 60% of the time on average. Therefore, if and when a borrower in an owner finance transaction inevitably defaults, you'll have to deal with the time, expense, and energy of the foreclosure process and also evicting the tenant. Keep in mind that rules and regulations around foreclosure and evictions vary greatly by state. For example, there are many tenant protections in New York, and evictions can take months, if not years. Furthermore, you should know that it is illegal to evict a tenant without a court order or a sheriff to do it in many states, including New York. So if the borrower simply stops paying, you cannot simply just go kick them out or change the locks. That would be illegal. So let's say that you were successfully able to foreclose and then evict the borrower. Well, then you have to spend significant time and resources and money to repair the home to be able to market it again for sale or rent. Most likely, during the foreclosure process, the tenant or the borrower in this case, has most likely not been too kind to the property due to a lack of incentive to take care of it. As a result, many homes that have been foreclosed on are usually in terrible condition, and moreover, if you have a poorly written loan document with the borrower in an owner finance transaction, the borrower may even take your appliances and sell them for some extra cash. So where does that leave us? Let's say the tenant tore the place apart during the foreclosure and eviction process, but you've managed to make repairs and the property is back to its former condition. Well, you're back at square one. And in fact, with seller closing costs as high as they are in places like New York, you probably have lost money even if you got some interim cash flow from keeping the down payment of, say, 10% of the sale price. You're probably still in the red. And of course, back at square one, if you wish to sell again, considering how high seller closing costs are in many states such as New York, well, you're gonna probably face a more substantial loss if you do manage to find another buyer, and hopefully this time you won't do a owner finance transaction and you'll wait for a substantially qualified buyer who can actually get a mortgage on his or her own. We hope you found this video helpful. If you did, please hit like or subscribe. We do come out with content on a regular basis, and of course, we help buyers and sellers save money on broker commissions, up to 6% when they sell or up to 2% when they buy. Check us out, www.housit.com. The spelling is below. Leave us a comment, and we'll see you on the next one.